Hi, good morning everybody and welcome to yet another video from the Smart CA initiative. My name is CS Kumar, and in this very short video, I'm going to walk you through the key changes to Schedule 3 of the Companies Act, the Division 1 particularly. And these amendments, as per the notification dated March 24th, 2021, are supposed to be with effect from 1st April 2021. So we need to have greater clarity on whether they are applicable for financial statements for the period ended March 31, 2021. But nevertheless, this is a sign of things to come. So in that context, this is a very short video that will walk you through the major changes. I'm not going to explain the changes because they're fairly self-explanatory in this PowerPoint presentation. So we'll just touch upon what the key changes are. So the first aspect is there are some general changes. There's a compulsory rounding of figures based on total income instead of turnover. Tangible assets everywhere have been substituted as PPE. And in the statement of profit and loss, the total revenue is now substituted as total income. Share capital. Now this is going to be a little fast-paced because I'm just introducing you to the changes, but we'll present a more elaborate presentation once things get clearer in terms of the date of applicability, etc. But this is possibly what one's client has to get ready for in terms of disclosures for the current period at least, definitely. Share capital, there is an inclusion, a specific inclusion of disclosure on shareholding of promoters. And this is the table, the promoter name, the number of shares, percentage of the total shares of the company, and the percentage change during the year. This is a new inclusion. Between short-term borrowings and other current liabilities, there is a reclassification. The current liabilities of long-term borrowings will come in the short-term segment, and it is not going to be shown in other current liabilities. It's a very logical reclassification. The third is the change made in trade payables. Now it appears that this Schedule 3 wants one layer more disclosure. The last layer being the actual trial balance itself. This is the second level that they want us to disclose. The trade payables aging schedule. It needs to be recorded as MSME, others, disputed MSME, disputed others. And what's very interesting in this is unbilled dues shall be disclosed separately. So if you're carrying any liabilities, I don't want to use the term provision, but if you're carrying any liabilities for services or goods received but bills not received, that also has to be disclosed. Tangible assets, there is one change which I've highlighted separately. Amount of change due to revaluation. If the change is 10% or more, is a specific inclusion in tangible assets. And a lot of it actually talks also to the revised CARO. So it's been incorporated to, sort of synchronize the CARO and your Schedule 3 disclosure. Intangible assets, it's the same thing. Any amount of change due to revaluation, 10% threshold shall be shown in Schedule 3. Long-term advances to other current assets, again, it's a simple reclassification. I've brought in the reclassifications together for the ease of reading. Security deposits are not shown under long-term advances, but it's shown under other current assets. Other current assets, they require a fairly detailed disclosure of trade receivables. Again, it's considered good, considered doubtful. This is under the heading of other non-current assets, disputed, undisputed, along with whether it is considered good or doubtful of recovery. Again, a very important thing is unbilled dues shall be disclosed separately. Again, where the due date of payment has not been specified, both in the case of trade payables, which we saw earlier, and in the case of trade receivables, if there's no specific credit period, etc., and the date of payment is not specified, you will reckon for this aging from the date of the transaction itself. And it uses the term transaction. So please, one has to be very careful. Trade receivables, again, there's a similar disclosure. Good, doubtful, disputed, undisputed. So they want enormous clarity on this. and unbilled dues shall be disclosed separately. Bank borrowings, the erstwhile clauses in italics and the current clauses, there's a very specific requirement where the company has not used the borrowings from banks and financial institutions for the specific purpose for which it was taken as at the balance sheet date. So I guess it's a continuing disclosure. It's not just for what loans have been received during the year. So the end use monitoring is sort of highlighted here, and it casts an obligation on the company to present such detail. Again, links to Caro of a very long time, which is the diversion of funds, etc., which was always there. Intangible assets, any of the assets other than PPE, intangible, etc., which do not have a value on realization shall be stated. So you may go through this clause in greater detail. Now we come to a special segment. Now these were all the changes under the existing headings. They've introduced a new heading Y after X, which speaks about additional regulatory information. Again, they want the title deeds of immovable property not held in the name of the company. Again, synchronizes with the latest Caro that's proposed to be implemented. So that's a specific requirement. Revaluation, where the company has revalued its property, company shall disclose as to whether the revaluation is done by a registered valuer. So the Companies Act was fairly clear on this. Now there is a new set of professionals called registered valuers. So you need to ensure the company needs to only get this valuation done by a registered valuer. There are new regulations for disclosure of loans and advances in the nature of loans which are granted to promoters, directors, KMPs, other parties that are repayable on demand or without specifying any terms or period of repayment. Again, the logic here seems to be to understand how much money the company has received and how much money have been given as loans and advances to parties who are close to the company, the promoters, the directors, the KMP or related parties. Again, I think a very logical sort of requirement from the company to highlight such cases of transactions. CWIP, they are now specifically requesting for an aging. Now, as auditors, we always went into CWIP aging to look at whether you needed to carry any provisions for impairment, etc. But you now have to present a very specific disclosure for CWIP aging. Where the CWIP is overdue or has exceeded its cost compared to the original plan, following CWIP schedule, completion schedule should be given. So they're also specifically talking about time overruns. So all this will definitely necessitate a lot more governance changes in organizations that, as chartered accountants, we must also be sort of prepared to do. Now, there are two ways to look at it. One way is, should have all this been called for in the Schedule 3? Well, not really. They could have still asked for a return. But as I've always said, I think there's been a lot of emphasis, and I think it's a matter of pride that a lot of obligation is now cast on the auditor also to certify this information, which is provided in Schedule 3. So I would rather look at this as an opportunity to assist rather than, only taking it as a liability. Of course, I think all these changes cast a very onerous obligation on the auditor and it substantially increases your audit risk. Consequent to which I'll have a separate presentation. I think we just need to look at a different fee level for most of the clients that we are handling, because these specifically require disclosure, and if it is none, you'll have to state. For intangible assets under development, again, they are asking. So if some money has been parked under intangible assets under development, the government wants to know how old is it. You just can't keep parking money somewhere and keep, not utilizing it. Similarly, where just as how in the case of tangible assets, where there were time overruns or cost overruns, they wanted a reporting, they've specifically asked for this. Now, it specifically uses the term original plan, which means, again, the governance frameworks would have to improve. You need to have capex budgets both for tangible and intangibles, and there must be a system of tracking the time and the cost and the overruns thereof. Benami property held, there's a very specific disclosure which is now made. the details of the beneficiaries, etc. So this has to be disclosed. Willful defaulter, where the company is declared a willful defaulter, you need to state so in your Schedule 3. And as an auditor, you would have to also counter check. If the company has said, no, I'm not a willful defaulter, then that also would come on record. So this is a specific disclosure on willful defaulters. Struck off companies. I had in several videos prior to this mentioned across my presentations that there's a huge bunch of struck off companies. I read somewhere that it's in the region of about 5 lakhs. So if any of your contractual counterparties, whether it is your debtors or your creditors, or whether it is your people to whom you have given loans and advances from, or whether you've taken loans and advances from, all categories of transactions, you may have invested in such companies may have invested in your company as shareholders. This is going to need a lot of work, where you take your entire customer stroke vendor stroke your counterparty masters, who are all corporates, and then you need to compare it with the MCA to figure out whether they are struck off or not. This also enhances the need for the company itself to monitor. Additional regulatory information, whether any charges or satisfaction is yet to be registered with the Registrar of Companies beyond the statutory period. So non-filing of satisfaction of charges or charge registration or satisfaction of charges, because it uses the term charge yet to be registered, satisfaction yet to be registered. Additional regulatory information, layers of companies. So there was a change under clause 87 of section 2, read with companies restriction on number of layers of companies. So this was a substantial change from the erstwhile Companies Act, which required companies not to have more than certain number of layers. So that compliance is very specifically asked. We need to disclose ratios. Again, I had mentioned in my Caro presentations that this has dramatically changed the way we look at audit. As an auditor, you were always sort of responsible for solvency, but today there is a specific Caro requirement on discussing whether short-term funds are available to meet short-term liabilities. This is a significant change from solvency to liquidity, and I think in order to strengthen the hands of the auditor in such Caro reporting, they're asking the company to disclose ratios. So here it's also very important that the basis of computation of ratios is also done properly. Compliance with approved scheme of arrangements. If the company, for example, has gone under section 230 for a compromise or arrangement. Now, if you notice on all the NCLT orders that are passed for section 230 compromise, it will say that you will implement the scheme and then ensure that your books of accounts reflect the relevant accounting standards for such compromise or arrangement and any deviations. So the requirement to comply with the revision in your accounting framework will also have to be disclosed. Utilization of funds and share premium. Again, this is again a link up to the revision in the accounts rules. I think it is rule number 11, which has come in again very recently, where company has passed on money to somebody for its ultimate benefit, and it's presented to a third level of entities. Again, I'm not going to speak very long about it because I intend this to be a short video. So this mirrors the change in the company's accounts rules. Similarly, where the company has received money and downstreamed it for the benefit of the giver of such funds, that has to be disclosed. For this, please go through the company's accounts rules also, where the relevant modifications have come on the same date. Very interestingly, on March 24th, 3 changes came. One was the Schedule 3, the changes to audit and auditors rules, and the changes to accounts rules in Rule 11. Statement of profit or loss, undisclosed income, again has to be reported. So previously tax assessments used to run on the right side and books used to run on the left side. Now they want to marry the two, and if you've been subject to any procedure by the income tax department where you've surrendered or disclosed income, unless there is such immunity for disclosure, you need to disclose it in the books of accounts. CSR, where the company is covered under section 135, the following shall be disclosed. So again, there have been changes to the CSR rules. Please go through. Amount required to be spent, amount of expenditure incurred, shortfall, the cumulative shortfall, the reason for such shortfall, why you have not spent the funds. So again, this is again a significant transformation. CSR first started very simply by saying you have to do. And then it said if you don't do, you disclose. Now the government is sort of moving towards a regime there where it says it's not just, your commitment to do, but please actually fund the CSR initiatives that you as the company have chosen to fund. So it's important. And details of cryptocurrency or virtual currency, which again is sort of gaining a lot of momentum these days. So they want very specific disclosures on profit or loss, amount of currency, deposits or advances. So again, this Schedule 3, if I want to summarize, does three things, which is exactly what the Companies Act stands for. ACT. This was mentioned by a very eminent banker in a presentation. It stands for accountability, corporate trusteeship, and transparency. It's a huge change again in terms of Schedule 3. And as I mentioned before, this is substantial, onerous increment to your audit work. And as far as I can see it, if I were to read the three things that we spoke about together, the rules, the auditor's rules in this Schedule 3, it's virtually doubled, if not tripled your work, and casts on the auditor, also a responsibility to ensure that there is a proper governance framework. I do believe these will significantly strengthen the audit profession because a lot of it now also becomes the client responsibility. And if your Schedule 3 is not getting complied with, you're going to report in your auditor's report that it's not complied, because if somebody chooses not to disclose, then it's not prepared. The financial statements are not prepared in accordance with the applicable reporting framework. Stay tuned for more. This was a very, very short video, but as more clarity emerges, we'll be happy to put out videos which discuss each part of the Schedule 3 and the changes and how one has to look at it. So I'm very thankful that you actually listened to this video, and if you have any comments, suggestions or feedback, please do mail in to sripriya@spka.in. Thank you very, very much and have a nice day.